Welcome to this explainer. Look, if you've ever stared at a trading screen and wondered what in the world those flashing green and red blocks actually mean, I'm right there with you. A lot of people just assume charting is some kind of secret black box magic. But today, we're debunking that entirely. We are going to dive into Gregory Morris's foundational text, Candlestick Charting Explained, and we're going to unpack this together. He presents price action not as a crystal ball, but as a dynamic, highly visual language that records real-time human psychology, supply, and demand. So let's see if we can decode these charts and actually learn to speak the market's language.
Okay, let's dive into this. Here is our roadmap for today. 1. Anatomy of a candlestick. 2. Reversal and continuation patterns. 3. The 5 methods of Sakata. 4. Psychology behind the patterns. 5. Filtering with Western indicators. And finally, 6. Building your trading system.
Section 1. Anatomy of a candlestick. The alphabet of price action.
I really want you to think of this explainer like learning a completely new language. We have to start right at the micro level by learning the alphabet. And to really appreciate Japanese candlesticks, we kind of have to look at what they replaced. Western traders used to rely almost entirely on standard bar charts. Just simple vertical lines with little horizontal ticks showing the open, high, low, and close. And sure, it gives you the raw mathematical data, but let's be honest, it's really hard to read instantly. Enter the Japanese candlestick system. This was actually developed centuries ago by Sakata rice traders, most notably a man named Munehisa Hama. Hama realized something absolutely crucial. Markets are driven by intense human emotions, fear, greed, hope, not just cold, raw math. So he needed a highly visual way to see those emotions instantly. The first thing you'll notice is the thick central area. That's the real body. It's essentially a visual translation of a micro battle between buyers and sellers. It tells you exactly who won the trading session. If it's green or white, the close was higher than the open, meaning the buyers dominated. If it's red or black, the close was lower and the sellers totally crushed it. Then you have those thin lines extending from the top and bottom. Those are the shadows, or wicks, and they show the absolute extremes of the fight, the highest and lowest prices reached during that session. So right away, the real body gives you this instant, undeniable visual insight into market control.
But what happens when that battle ends in a dead tie? Well, that is called a doji. The opening and closing prices are practically identical, which leaves a real body that's basically just a thin horizontal line. A doji signifies absolute balance or a total loss of directional momentum. But here's the catch. The context, specifically where those shadows are, tells wildly different stories. For instance, a long-legged doji means crazy volatility but total indecision. A dragonfly doji with its long lower shadow means sellers drove the price down but buyers violently rejected it. That's a super powerful bullish warning if it happens at the bottom of a downtrend. And then there's the gravestone doji, which, sounds just as ominous as it actually is for a trend. It warns of massive buyer exhaustion right at the absolute peak of an uptrend.
Section 2. Reversal and continuation patterns, forming words on the chart.
Actually, scratch that. Before we even start putting these letters together into patterns, we have to anchor ourselves to Gregory Morris's absolute non-negotiable golden rule. A reversal pattern requires a pre-existing trend to reverse. Listen, if you see a beautiful textbook reversal pattern in the middle of a sideways, choppy, directionless market, it carries zero statistical significance. Just ignore it, do not trade it. You absolutely need a clear prior trend for the pattern to actually mean anything.
So, the crucial point is knowing which words carry the most weight. Let's walk through this quick cheat sheet. You've got your single candle reversals, like the hammer at the bottom of a trend or the shooting star at the top. Moving up to 2 candle patterns, we have the highly reliable engulfing pattern. That's where the second candle's massive real body completely swallows the previous candle, a literal visual representation of a total change in dominance. But notice those 3 candle patterns at the bottom? The morning star and the evening star. Through rigorous computer testing of decades of historical data, Morris proved a vital statistical realization. 3 candle patterns are historically far more reliable. Why? Because they have built-in confirmation. They don't just show a sudden one-off shift, they show the initial shift and then the actual follow-through.
Now, while everyone loves hunting for tops and bottoms, the truth is the majority of money is made trading with the established trend. And that's where continuation patterns come in. They act as brief rest stops on the primary journey. Windows, which Western traders call price gaps, show such overwhelming momentum that the trend literally skips a price level entirely. Then you have the rising and falling 3 methods. These show shallow, low-volume profit-taking. It's just a brief pause before a massive candle resumes the dominant trend. And Matt holds, those are your high-probability entries. They indicate extreme, aggressive trend strength.
Section 3. The 5 Methods of Sakata, the sentences of market structure.
Okay, so this is an 18th century philosophical framework originally formulated by Munehisa Homa, and it's actually kind of mind-blowing how directly these ancient Japanese principles map onto what we see today in modern Western technical analysis. For example, San-sen, or three mountains, is literally your classic triple top or head and shoulders pattern. San-ku warns that 3 consecutive gaps mean the market is overextended and exhausted. San-hei highlights sustained institutional momentum. Think of the 3 white soldiers pattern. San-ren preaches patience during consolidation flags, and San-o reminds us that markets always move in a rhythmic wave structure of advance, pullback, and advance. The geometry is literally timeless.
Section 4. Psychology Behind the Patterns. Reading Human Emotion.
Let's do a quick mental reset here. We've talked a lot about shapes, but why do these shapes actually work? Take a second and try to look past the green and red ink on your screen. Don't just see the geometry, see the humans. At the end of the day, markets are driven by real people, processing information through the very messy emotional lenses of fear, greed, hope, and regret.
Think of it like this. A candlestick pattern records the precise millisecond when the collective psychological state of the market snaps. Picture a panic selling spike. Prices are crashing, fear is at a total fever pitch. Finally, retail traders with weak hands just capitulate and dump their positions at any price they can get. But guess who's waiting quietly at the bottom? Deep-pocketed institutional investors. They step right in and scoop up that massive discount. This giant influx of capital pushes the price back up, creating a long lower shadow, a hammer. Suddenly, the retail traders who just sold in panic see the price surging back up. Their panic instantly turns to burning regret. Short sellers rush in to buy back their positions just to cover their losses. The dominant group simply ran out of emotional conviction, and the candlestick captured that entire psychological drama perfectly on screen.
Section 5. Filtering with Western indicators, adding grammar and context.
Now, here's a hard truth. If you try to trade every single candlestick shape you see, you will probably trade your account down to 0 in about a week. Markets are full of random noise. That's why Gregory Morris insists on a quantitative approach. The candlestick provides the early warning, but Western indicators provide the absolute required quality control before you ever click buy. You have to filter the signal. A morning star is great, for sure, but is it happening above a rising moving average? Because that confirms the macro trend is with you. Are your momentum oscillators, like the RSI or stochastic, showing that the asset was oversold? Great. But above all, do you have volume? Volume is the fuel. If a reversal pattern happens on super low volume, it lacks institutional backing. It's probably just a trap.
Section 6. Building your trading system, a practical blueprint.
Before we build the system, we must firmly anchor our second golden rule. Gregory Morris says it perfectly: never trade in no man's land. A candlestick pattern is only statistically valid if it occurs at a major structural level on your chart, a major support floor, or a massive resistance ceiling. If a pattern prints in the empty space right in between those levels, it's noise. Ignore it entirely.
Okay, here's your 5-step blueprint to bring this all together. Step 1. Look top down. Always check the weekly and daily charts first for the macro trend. Step 2. Value zone. Sit on your hands and wait patiently for the price to hit a major support or resistance level. Step 3. Pattern ID. Spot your hammer or your engulfing pattern. But, and this requires absolute iron discipline, wait for the candle's session to officially close. I cannot stress this enough. An unclosed candle can look like a beautiful bullish hammer midday and completely collapse into a bearish nightmare by the closing bell. Step 4. Apply your filters. Check your volume, check your moving averages. Finally, Step 5. Execution. Enter the trade and immediately place a hard stop loss just below the extreme shadow of the pattern, because if the price breaks that wick, your technical thesis is completely disproven. Get out without emotion.
And this brilliantly illustrates the real climax of our explainer today. This is the aha moment that really clicked for me when exploring Morris's work. East meets West. These two disciplines are not enemies. They are actually two halves of one complete, highly effective trading system. Western technical analysis, your support lines, your moving averages, that gives you the macro bird's eye view. It tells you exactly where the battle is going to take place. Japanese candlesticks, on the other hand, provide the micro, zoomed-in view. They tell you exactly when the battle starts, and crucially, who is winning in real time. Combine them, and you effectively eliminate the blind spots of both.
The market is never silent. It is always broadcasting its psychological state to anyone who actually knows how to read it. So now that you understand the alphabet, the words, the sentences, and the grammar of price action,
What narrative is your chart telling you right now? Go pull up your favorite asset, find those major structural levels, and see what the candles are really saying. Thank you so much for joining me for this explainer. Keep studying those charts, and I'll catch you next time.